In today's video, I'm going to be showing you exactly how smart money is making over a 100% APR in the current market circumstances as well as in future market circumstances. How they are using this market right now to generate passive income and cash flow off of their cryptocurrency assets. We're going to dive right into today's video. Now, I want to talk about what smart money actually is, because obviously smart money is better than dumb money. I bet we can all imagine that. Smart money are those investors that are institutional level investors, not just with capital, but with knowledge, because you can have a lot of money and it could be dumb money, right? And we don't want that at the end of the day. We want to use our money smartly. And when we refer to smart money, we're referring to the top institutions in this industry, the people that have hundreds of millions of dollars, even tens of million dollars, and sometimes just millions of dollars, right? They have a proven strategy that has allowed them to get to where they are at today, basically. Well, just because they have a shitload of money doesn't mean that we can't copy them, right? And that's the beauty of this industry. What's available to one with $100 million is available to the next person with $10 or $100 or even $10,000, $50,000, $100,000. And that's exactly what we teach people in our DeFi legacy program, how to become smart money without having tens of millions or even hundreds of millions of dollars to deploy in capital. Yes, we've worked with people that have $1, $2, $3, up to $5 million in the past. We've also worked with people that have $10,000, $50,000, $100,000 in the past as well. These strategies work for everybody because we are in the decentralized finance industry where opportunity is available, and it's available to everybody and everyone. So if you guys watched my last video, we talked about crypto to crypto liquidity pools, crypto to stable liquidity pools, and stable to stable liquidity pools. Today, I'm going to be breaking down my exact flywheel that is backed by literally about 10 plus frameworks for building a DeFi portfolio and what I actually do with my income, so on and so forth. So the first thing that I like to do is I like to allocate more towards crypto to crypto liquidity pools, right? And the reason why is because these ones are going to have growth potential. Now, with that being said, just because I'm in crypto to crypto liquidity pools does not mean that I'm going to be doing low income and have a ton of growth potential, because you could introduce higher risk assets that still have a lot of growth potential, but also have high income. Anyways, I allocate 80% of my capital to these crypto to crypto liquidity pools, and I allocate 20% of my capital over here to these crypto to stable liquidity pools. At the moment, I have a 0% allocation to stable liquidity pools. Now, in the instance where I think the market is at a relatively high price, I'm taking my income from both of these and I'm parking it in stable to stable liquidity pools that will generate about a 20% APR. So nothing too crazy. 20% APR is great, but when there's a marginal amount of capital in there, sometimes it's not worth it. And that brings me to my next point. At the moment, I'm taking this income and I'm parking it in stable coins, but I'm not parking it in stable to stable liquidity pools because of the fact that every single week or so, I'm consistently deploying the stable coins that I get in income, basically, into HODLs, into new crypto to crypto liquidity pools, new crypto to stable liquidity pools. It's being deployed after about a week or so. So it doesn't make sense to park it in here, make like $1 or $2, but ultimately pay, $1 or $2 in gas fees just to get into the opportunities, right? But then when it comes to my crypto to crypto liquidity pools, it's important to talk about risk allocation. I typically go for about a 50% mid-risk allocation. Now, that's not 80 minus 50 leaves us with 30. That's actually 50% of the 80. So about 40% overall is going into these crypto to crypto mid-risk liquidity pools, basically. Now, another 35% is going to go into what I like to call high-risk plays. And then we have another 15% in what I like to call ultra high-risk plays, UHR, basically. Now, what exactly is the difference between a high-risk and an ultra high-risk? Really, there's no set structure for this at the end of the day. But what I'm looking at here in my high-risk plays are assets that are new, assets that have lower market caps, but ultimately have a fundamental driver that is almost guaranteed to drive them up in price over the next 2 to 3 years. Whereas when I'm looking at ultra high risk plays, I'm looking at plays that are new, plays that maybe aren't generating an income quite yet in their business, plays that have an ultra low market cap or ultra low TVL, right? That's the way I differentiate it. In my portfolio right now, I currently have $16,000 allocated to Ethereum to Aave, right? This is what I would consider a mid-risk play. I have $5,000 allocated to Spec to Ethereum. This is what I would consider an ultra high-risk play. And then I have about $22,000 allocated to Ethereum to Aether, which is going to fall under my high-risk section. Reason why? Aether is a market cap lower than $1 billion. But with that being said, it generates more income in the business that backs Aether than Render does, which is a market cap of $2 to $3 billion, right? So ultimately that tells me that Aether has a lot of growth potential, and it's almost guaranteed if it comes to proper valuation, basically. Now, obviously, that's not the exact allocations that I showed you here, and the reason why is because things get out of whack when you start making or losing money. This Aether position has made me $10,702 over the course of the last 3 or 4 months that I have been in this position for, basically. So it's gone from being about 35% to now being a much, much bigger portion, basically, and actually overtaking the mid-risk category. But I'm fine being allocated to it because the position is playing off as it should. Anyways, as you can see here, this sector of the portfolio is doing a 105% APR. Pretty damn good. So let's go ahead and jot that down right over here. These three are doing a 105% APR. Now, I would target about a 100% APR when the market's going up, maybe a 120% APR for my crypto to crypto liquidity pools, especially with these allocations. Again, your goals should adjust depending on the market circumstance. Before the bull market started back in November, targeting an 80-90% APR was a relatively good APR. That's what I was doing in my portfolio, and I was very happy with that. Now I'm wanting more like 110% overall in my portfolio, and those expectations are going down a little bit as the market does cool off. But as new institutional money comes in towards the end of January, February, March, April, so on and so forth throughout this year, I am going to be adjusting my expectations to be higher once again because there's more volume within the market. We are seeing more trading activity. Now, when it comes to actually selecting these positions right here, what positions are we going to use for mid-risk, high risk, and ultra high risk? How do we categorize those? That's where we actually use something called the Fate framework, where we go in and we discover different assets. We look at the fundamentals, we look at the APR, we look at the TVL metrics, and then we look at the exposure within those specific liquidity pools, basically. That's a framework pulled directly from our DeFi legacy program. But after we've determined which positions kind of fit under that Fate framework, we go through the range framework, which is finding the ranges for those positions. We go through the valid framework to make sure that we are validating the position and it is actually a good position for success, basically. Now, the next thing that I want to go ahead and talk about are crypto to stable liquidity pools. These ones, I keep a relatively simple allocation. I have 100% of that 20% just in low risk crypto to stable liquidity pools. Why? Well, the reason why is because if I'm in mid-risk or high-risk assets, a lot of the times these are going to be paired with crypto to crypto liquidity pools. And that's because you're only really going to see a lot of those blue chips paired with stable coins. Because ultimately you see, say, a high-risk asset or mid-risk asset paired with Sol or paired with Ethereum or paired with a gas token of a specific network, right? And you're going to generate a higher APR on the ones that have market volatility and full market exposure than you are on the ones paired with stable coins, basically. So if I just go with 100% low risk over here, basically I'm mitigating my overall risk and I'm actually bringing down my overall risk because I have a backbone of the portfolio that's generating me consistent income, but also at the same exact time giving me partial market exposure to kind of mitigate some of those market moves. This right here is just going to be doing a simple 100% APR, which is what I'm targeting with pairs like Sol to USDC, Ethereum to USDC over an Aerodrum, stuff like that is what I'm including under this sector, basically. So 20% of the overall portfolio allocated to low risk crypto to stable liquidity pools doing a 100% APR, basically. Now, overall, this will bring my APR to something like 104% or so, still hitting my benchmark of about a 100% APR. And then stable to stable liquidity pools, shall I were to include these in the portfolio, I'd be targeting roughly a 40%, maybe 30% APR, depending on the market circumstances. Now, with that being said, this is going to be a little bit more risky than just parking some USDC and USDT on OV and getting roughly 7 to 10%, basically. But with that being said, you can take different levels of risk depending on the stable coins that you want to have exposure to, the smart contracts and platforms you want to have exposure to, basically. That's what you have to determine when going into stable to stable liquidity pools. So now that we've outlined our allocations, we're going to dive more into what happens after deployment. And the first thing that I want to go ahead and mention is within our DeFi formula roadmap, which is our proprietary roadmap under our DeFi legacy program, basically, what I just outlined is phase 1 and phase 2, basically. Blueprinting and constructing your portfolio. Ideally now, you would have found positions, you would have got deployed, and you would actually went through phase 3, launched the portfolio. Now we're going to dive into the manage phase as well as the scale phase, which is through our DeFi velocity method. And this is where we start to create our portfolio flywheel. How can we make our portfolio grow without having to inject more capital, basically? How can we make our income on a monthly basis grow without having to inject more capital? So by now we have a couple of different eggs, basically. We have that crypto to crypto egg that is generating us a cumulative 105% APR. We have that crypto to stable egg that is generating us a cumulative 100% APR basically. Now, under these eggs, obviously we have more eggs basically. Under our crypto to crypto, we have our mid risk, we have our high risk, and then we have our ultra high risk basically. And then under our crypto to stable, we just have one egg, which is going to be our low risk. So the first thing that I want to go ahead and mention, my crypto to stable, basically no matter what I'm doing with this income is not going back into the crypto to stable liquidity pool. And the reason why is because I'm generating income on it. I'm happy with that income. Granted, maybe the market's at a super low price. And yes, maybe I will take that income and I will compound it. So that way I can see some growth potential because I am investing at a relatively low price. And then I can produce a little bit more income later on. But for the most part, the income generated from this crypto to stable liquidity pool is going back into my crypto to crypto positions. Now, which positions is it going into? Well, it's not going into the ultra high risk because I already have enough exposure there. I don't want to allocate more money there until I've already made my money back in fees. I've extracted my initial deposit in fees, and I can also at the same time extract my initial deposit if I need to basically. So that way I've kind of doubled up on my money, and then it's like I could start playing with house money, and then I could start compounding, going into ultra high risk positions, stuff like that basically. But for the most part, this low risk income is going to go into my high risk positions as well as it's going to go into my mid risk positions. But it's going to depend on what's currently happening in my portfolio. Like right now, I just showed you that I currently have a lot of my capital in this high risk position, Ethereum to Aether, and a smaller chunk of my capital in Ethereum to Aave. Now that being said, right now, I'd be looking to allocate the majority of my income from this low risk position into my mid risk position so I could get it back up to allocation, right? Remember how we set out these allocations? A lot of people think, oh, we need to rebalance to these allocations. That's wrong. You need to use your fees to rebalance to these allocations basically. Meaning if your high risk does overtake your mid risk and become 50% and then your mid risk becomes 35%, don't just go and sell some of your high risk into your mid risk unless you're ready to take profits on your high risk, right? Go and use the income from all of your positions even to balance out this portfolio. Once again, my income from my high risk position is usually going to go back into the high risk position or it's going to go back into the mid risk position. But a lot of the times I'm actually taking it elsewhere. I'm taking that income and I'm putting it into HODL assets. And the reason why is because these assets that I'm parking in a high risk position, liquidity pool basically, like Aether, these are correlated at time, right? But ultimately this correlation is going to end up breaking eventually, right? Because Aether is most likely going to go on a run. And then of course, all of my Aether is going to be sold into Ethereum, and I'm not going to be that happy because I'm going to have a lot of divergence loss. And obviously my goal is to make the most money possible, which means that I'm going to need to take some of that income from that high risk position and park it in HODLs. And when I say HODLs, I specifically mean the asset that I am investing in basically that has a lot of growth potential. Aether in this example, right? I would take the income from my high risk position and I would park it in Aether. Already half of that income is paid out in Aether roughly. I'm just going to take the other half, which is paid out in Ethereum, and convert it into Aether. And that allows me to build up a bag of Aether. So that way, if Aether does end up going up, say 50% over the course of 2 weeks or so, while Ethereum only goes up 10%, and I have a bunch of divergence loss, well, guess what? The whole bag of Aether that I was able to build out is going to see that price appreciation. Now, in the instance where I'm happy on the HODLs, once again, that's where it's going back into the high risk or back into the mid risk. Or in the instance where my, let's just say, income generating versus HODL portfolio is a little out of whack. Once again, that's where I'm going to reinvest in the liquidity pools. I like to have 60% in HODLs and then 40% in income generating liquidity pools, right? Right now, I have about 35% in the income generating liquidity pools. So ultimately, I'm going to be reinvesting a lot of this income right back into the income generating portfolio. I'm not going to be reinvesting it into HODLs at the moment because my portfolio is a little out of whack. I want to get it rebalanced. I'm rebalancing it using the fees. I'm not going and selling different assets. This is good for number one, tax purposes, so you don't have to sell as many assets, but at the same time, it's also great for just making sure that you're not finalizing profits when you're not ready to finalize profits, or not finalizing losses when you're not ready to finalize losses, right? And of course, you're going to end up rebalancing your portfolio, and then the next day, it's going to end up going out of whack again. So you use your fees to keep your portfolio in check, basically. Now, my income from my mid-risk position, a lot of the times this is either going to go back into the mid-risk position or once again, it's going to go into the HODL. So I imagine you guys can kind of see a trend right over here. Low risk is obviously complementing the high risk and the mid-risk, right? Whereas high risk is going to complement the high risk and the mid-risk, whereas mid-risk is just going to complement mid-risk or, of course, the HODL, like the high risk would. Well, following that logic, if we were to dive into our ultra high risk, well, where's that income going to go? Well, it's going to go into the high risk, or it's going to go into the mid-risk, or of course, course, it's going to go into the hodls. Now, a lot of times if it's going into the hodls, I will allocate a very, very small amount to the ultra high risk asset, and then I'll allocate the rest to high risk or mid risk assets, basically. Once again, frameworks that we teach within DeFi Legacy, if you guys want to check that out. But the point is, having a system like this, which this is a very, very ugly way of drawing out your portfolio, shall I mention, right? Your portfolio is going to complement itself. Your portfolio is going to grow on its own. And maybe perhaps you're earning, say, $1,000 in income 1 month, right? And you're earning 10% per month, basically. And you have $10,000 invested. It's $1,000 month one. But then since you're compounding your income, maybe the next month you earn 1.1K. And then the next month after that, you earn 1.2K, and so on and so forth. Your portfolio can grow. The best part is it's not going to grow linearly. It's going to grow exponentially if you're compounding, because ultimately your 10K now becomes 11K, and then you generate 1.1K off your 11K, and your 11K now becomes 12.1K, and then you generate a total of 10% on that, which is going to be about 1.21K, which means you now have 13.31K basically, and your portfolio is just going to grow exponentially basically. And this, in my opinion, is one of the best flywheels that you can implement into your DeFi portfolio to start earning passive income. And if you guys are looking for my personal support along with my team support in building out a flywheel for your portfolio and actually executing on a strategy like this to consistently earn over a 100% APR in your portfolio, then feel free to check out our DeFi Legacy program. Again, if you don't want to, that's completely fine. DeFi Legacy really is meant for those that are truly trying to take their portfolio to the next level. It's a one-on-one coaching program where we're literally going to dive into your portfolio with you and help you build out the portfolio. So again, it's for those serious investors only. The link is going to be right below this video. I hope you guys did enjoy. If you did, drop a like, make sure to subscribe, and of course turn on notifications so you don't miss out on my next videos, and I will see you guys in the next ones. Peace.